So it's another opportunity for you guys to know how many different ways there are to make money in this market. It's not just buying shares and selling shares, right? And it's not just buying calls alone. It's just not buying puts alone. It's not just doing vertical spreads alone where you buy calls and sell calls or vice versa. It's not just buying a range alone, but there's another way or many ways in this market exist how you can make money. So far, I try to cover as much as I can or try to teach you guys, but these um, uh, different ways of making money in the market requires a lot of research. It requires a lot of understanding of numbers. It requires a lot of work. It's not something easy. Sometimes it's easy to know, okay, this is how you do something, but executing it and knowing when and how to execute is what matters the most, right? And to learn that, it's a lot of practical experience that you have to build up in the market. Okay. I mean, if you're a doctor doing a certain surgery by looking at it, oh, this is what we have to do, fine. But when doing it and knowing how to do it, then your hands start trembling, right? So same thing in the market. So today, our session will be um, covered calls. Now, some of you guys might not have the account to do such strategies, but it's always good to know these things because you can still learn them if you're not able to execute them. In the future, when your accounts are big, you have more money, or you know the possibilities and the various ways of making money in the market. So what exactly are covered calls? Now, covered calls is basically when you own equity on an underlying stock, right? So let's say, for example, I have any open here on my left side. So covered call is basically when you sell calls to collect premium, okay? So you sell calls to collect premium. Now, when do you sell calls? So selling calls is one thing, but if you sell calls alone, there's a lot of risk in it, right? I mean, if you sell one call at $1 and the stock jumps up and the calls go to $10, now you gotta buy them back at a higher cost, right? And if it's about to expire. But how can you sell calls and still stay safe on the sides, right? And so selling covered calls, number one, let's say we are trading stock A and Y, right? A and Y, you buy 100 shares. For every 100 shares you buy, you can sell one call or one put, doesn't matter. We'll go with covered calls, right? Vice versa, same thing for puts. You're able to sell one call for every 100 shares, all right? So stock is any, for example, for every 100 shares, you can sell one call to collect premium. Now it comes with a lot of downside risks also, right? It comes with some pros and cons. We'll go over them slowly, right? But first, I'm just going to teach you guys the basics. Let's say any is trading at 828, just for an example, and you want to make some money and you own equity. Let's say you own 100 shares of any. For every 100 shares equals one contract, okay? Because when you buy one option contract, one call, is you're controlling 100 shares of that company, okay? So every 100 shares you own, your broker allows you to sell one call, okay? Let's say any is trading at 828 and the IV is really high, the volatility here is really high, and now you want to take some advantage of collecting some premium. Let's say you think it does not go high, or maybe you think it goes high, but only to a certain range. Now you can see 10 and 11 is resistance here. Let's say you choose this resistance $12, just for example, and the further expiry you choose, the more premium you can collect. But let's say you choose a 3 week sell, just for an example. All right, so you choose the strike, just follow along. So if it doesn't make sense, it's okay. Don't worry about this making sense. At least if you get a little bit of idea, then you can slowly keep on learning, and eventually it will all make sense the longer you stay in the market. And you choose strike 12, for example. Expiry, let's say you choose 1 month out, just for example. 1 month out from today. So you choose 1 month out. Now, can you guys see my font, by the way? Do I need to make this bigger or it's okay? Thank you, Saxon.
Yeah, that's fine.
Yeah, that's fine.
Thank you. So let's say we go 1 month out. Now, 1 month out on this volatility, given the Bitcoin strength, let's say maybe they're selling this for, I'm just going to make up a number. I don't know what they're going for. Let's say the premium is going for, so let's say premium here is $1. Okay. You choose to sell one call at $1. So first we own 100 shares. Let's say you bought 100 shares at $7 for any, right? So this equals 100 times 7, right? So $700, your 100 cost of 100 shares. So your cost right? $700 for, so you want 100 shares at $7. It's $700 is your cost, which you have invested in it. Okay. Now there's one call that you sold for $1 premium. You're collecting how much? $100. All right. You're collecting $100 of this premium. Let's say you sold this $12 strike. You're collecting $100. Any is trading at 700. Your current value of this any is $828. So you're already up 128 bucks on equity, let's say, for example, but you want to make more money. You want to take advantage of this high increased volatility, and you want to sell some calls here. You sell this for $1. So you collect this $100 premium. Okay. Now, what exactly happens if any goes towards, let's say, give me a closing price, guys. Let's say after 2 weeks, let's say any stays at this price. Okay. Let's say any goes up here. So any goes up or it comes down, does this little thing, and it just stays around $9. All right. Now, because the stock did not make a big move up, even though the stock went up, the delta and with theta, with all the calculations of Greece, this is now premium now is selling for maybe 0.70. I don't know. I'm just making up numbers here. Let's say the premium has fallen here to 70 cents. Okay. Any's trading at, let's say for the current value is 828, and any's back at $8.28 or even at 9, right? So let's say any's trading at $9. So your current value is $900. And the stock did not continue going up. It went in a chop for 2 weeks. After 2 weeks, you're looking at your call, which you sold for $1. You can choose to buy this back at 70. If you buy this back at 70, you keep the $30 profit that you got. Okay, so there will be additional $30 profits. Okay, on top of your equity. All right, there's just a different way of making money. You can buy this back at 70 cents. You keep the $30, $100 minus 7. Are you guys keeping up with this? Because you guys will have to listen to me more than following the Excel sheet. You guys can unmute yourself and speak if you want. Okay, Carson. Because these numbers, if somebody's looking at them, they're going to be all over the place. So just follow my voice, and it will make more sense. Yes, I will try going a little bit slower. And you can buy this back. And if you think any does not go above 12 by the expiry, if you think any does not go above $12 by expiry, so let's have a different options here. Option 1, right? Any goes to 9. Okay, any goes to 9. Our equity goes to $900. The call that we sold for $1, the value is $100, right? Let's say because any did not make in 2 weeks, because any did not make such a big move, this will not be higher than $1. Only if next day any went up a lot, then this would be high. Of course, we'll go to that option too. If it goes much higher, what exactly happens? So at 900, and here the premium comes down to 70 cents, right? You have an option to buy this back at 70 cents if you think any is going to strengthen and is going to break out again. Okay. If you think it might break out again and take out, and these prices will jump up again, you don't want to hold on to them. Okay. If you're seeing strength, that's number one option. But if you think any's here and it takes a more dip towards 828 or 850, then you can continue holding this. Okay. Any goes to 9 in 2 weeks. And now you think any goes lower. Okay. Let's say any comes to $8.50. This will lose even more premium. Now this premium might be worth maybe $0.40. You can now buy this back at 40 cents and lock in that $60 in profits. All right. So covered call, basically you're selling call against your equity that you have. For every 100 shares, you can sell 1 call. Okay. And then, so this thing I hope makes sense. As the calls lose premium, you just buy them back at cheaper. Okay. Now that's option 1. What if any flies next day? What if any goes to $20? What happens? Right? What if any goes to $20? What happens? If any goes to $20, right? So option 2. What happens if any goes in the money and this stock just happens to squeeze? Any goes to 20. Let's say it squeezes. What's the premium of this call? What will be the intrinsic value of this? If we're buying the $12 strike, and intrinsic value, if any goes 20, is minimum $8, 8 plus some premium. All right, so let's just keep $8, so it's easy for us. So $8, and the value for that will be $800. Okay, and because you sold this at $1, now you're gonna buy this back at $800. What happens? Your option, your any will get exercised. So what the market makers will do, Your any stock will be sold at 12. So you get to keep the profits only up to $12 a share. Okay, only $12 a share, which is 1,200 bucks. And the other $800, the market maker will take from your shares that you had. So 100 times the other $8, 800, they will cover your call. Okay, so your max profit here is only up to 1,200 now. Okay, your max profits are only up to 1,200. Okay, so $700 was your initial investment, $500, your max profits are capped, and this $800, any can go to $100, it can go to 200 bucks. The market maker will cover that call from your shares. Your shares will automatically get sold, and you will no longer own the shares unless you buy it with additional cash. You buy the call back, and then you know you cover your call. Okay. Is this making sense for you guys? A very small part, or do I need to go into more details? If your call that you sold goes above the strike price, and it stays there, your max profits will only be up to 12 on your equity, and your call, anything above 12, all your shares will be sold, and that $800 will be covered on expiry by your market maker, right? Because you have 100 shares, 100 times 20. The $8 difference, that's $800, and that's the intrinsic value of your call. Is this making a little sense? It's very advanced if you're new at options. If you're new at options, I know this is very advanced, but if you have been doing options, it will make more sense. Now, Bryson, if your any stays the same, if any stays under 12 bucks, if it stays under 12 bucks, right? If it stays the same, so let's say any stays under 12, what you're asking, I believe, stays under 12, and you continue holding this call. Well, nothing's going to happen because these calls will expire worthless, and you will continue holding your shares. You basically lock in this entire $100 profit, right? So option 3, any stays under 12, you keep all the premium. It's simple. You keep this $100. That's your free money in your pocket. That's what most of market makers do. They own a lot of equity, and then they keep selling covered calls against their equity that they have, right? Now, I'm going to give you guys some points on this. What are the pros and cons of doing these things? Now, sometimes when we do covered calls, when we sell them, now any is a very volatile stock, right? It's a very volatile stock. Tomorrow, let's say your entry was $7 at 700 bucks. You sold the same calls at $1. Now, what happens if any tomorrow gets really volatile? Let's say any goes up $3. So let's say any goes up $3, it comes down $5, and then it comes back to 828. Let's say after 3 days, huge volatility, right? Increase in IV, we say increase in IV. If you don't know what IV is, increased volatility, right? Increased IV may increase the option price. Even the option may increase the option price at the same stock price you sold the option at. So let's say, for example, here at 828, we sold the $12 strike at 1 because the stock made some big moves. There's something called IV which increases. This call can now be worth maybe 125. Even though the stock price is the same, or stock price can be lower than when you sold the premium, but now the call is going for even more because there's increased volatility, right? Because the market maker is unsure of the moves. A big move can happen either way. All right, so sometimes call prices go up that way, and sometimes that's the best time to sell calls, because as soon as the IV cools down for 1-2 days, if the stock makes less moves, these go down by a lot, right? So if we go on any, if we just look at the example right here, so those people that bought any or had 100 shares here, right, and they saw resistance here, they probably sold a lot of calls here. They probably sold a lot of calls, and as soon as any the next day went here, any went sideways for many weeks, and those people probably collected so much premium so fast because they just completely died. And now the any has taken over these previous prices, the IV in calls have increased. So and now I own a lot of equity in any. right? If any does happen to go 11, 12 bucks, right? If it does happen to go over here, and as soon as I see a little top, I might sell $15 or $17 calls a couple of weeks out to collect some premium. Okay, because I'm not going to sell my any equity. I'm going to hold it even if it dips. This is something that I see a long-term potential in. As a Bitcoin play, and we know what Bitcoin plays can do. Then I will probably just slowly start. I will sell some calls here and keep that premium. Maybe I'll sell them, and after 2 days, I will cover those calls. That's a great way to make money in the market. Okay, and did that make sense, guys? Is this something new that you guys are learning? Vikram, Hassan, Ritik, Optimus, Pratik, Yash, right? And so that's one. And sometimes with covered call, would see the thing with covered calls is sometimes it limits your potential. Now, let's say if I sold this at $12 call and tomorrow any squeezes, let's say any squeezes to, or let's okay, neg is a perfect example for this. Let's say you did neg covered calls back here, right? Before this whole maniac move, right? Sometimes stocks happen to make these moves. It went from 10 bucks all the way to 80 bucks. Let's say on neg, you sold some calls here thinking it made a huge move. Let me sell some calls here, right? Now your profit here was limited up to your strike price, right? Anything that you sold above this, and if your expiry was above here, above this thing, obviously, your profits were limited. You could not take advantage of this equity hold, right? Because your calls that you bought were probably exercised above this price if they were shorter dated, obviously, and you completely lost it against your equity. I mean, your equity gains were limited because now you got to buy back the calls, right? I mean, if here any goes above 12 bucks and stays above 12, the market, your shares will get exercised because now you have to buy back these calls, right? Because what you sold, you have to buy back also. You only don't buy it back when it's zero, if it expires worthless. The only time you don't buy back is when they expire worthless and you keep all the premium. Okay. And or by expiry, if there's any value left in your call, intrinsic value, your shares will be exercised, they will be sold to cover that, and then you keep whatever the profit is that you get. Okay. So you do covered calls when you think the stock price is unlikely to rise, right, much further in near term. Usually it's the best to do covered calls for the next 30 days. And you're holding a long position in a stock, right? And then you sell the same size. And if you have 1,000 shares, you can sell up to 10 calls, right? So for every 100 shares, you own, right? So for every 100 shares that you own, for every 100 shares you own, you can sell one call. You can sell one call, okay, one covered call. And it limits your upside profit, obviously. And now let's say, for example, I'm going to give you guys a very basic example right now. Okay, I'm going to do a very basic math. Okay, let's say stock any or stock, this is on Investopedia also if you guys want. Investopedia has a great example. Let's say stock any is currently trading at so let's do this one live. Let's say if we were to do this live, any is trading at 828, right? $8.28. Okay. And you're selling and we own 100 shares. Let's say we own 100 shares at $828, and we sell one call. We sell let's say we sell $10 call for a premium of let's say $2 1 month out. Okay, so 200 bucks. Okay, so you collect $200. You collect $200 and you purchase this any at $8.28. And right away, your profits here is 1,028. You already, if any stays sideways, and any goes to, let's say by expiry, any is trading at $9.50. Okay. Now your equity worth will be how much? $950. Okay. These calls will be what? These calls will go to zero. So what are your profits here? Your total profits equal 200 plus 950, 1150. So you increased your return not only in equity, but by selling some premium as well. Yeah. So 1150 is your total. But let's say any goes to, let's say any goes to $12. Okay, any goes to $12. Your equity is worth 1,200 bucks. Okay, your equity is worth 1,200 bucks. And your total profit, what are your total profits now? Just give me 1 second. What are your total profits now? If equity stock price is 12, right? You sold the $10 call at 2, your stock price at 12, so your equity is worth 1,200 bucks. What are your total profits? Your intrinsic value for the $10 call is also $200 now. Okay, your intrinsic value, the intrinsic value is 200. Okay, your profits here are now limited. Your profits here will equal 1,200, your equity worth minus the $200 which you're gonna buy back. So you basically made nothing at 200 bucks. You collected, and your profits here were limited. You only made $172, right? The 1,000 less your 828, obviously 100, right? So this equals 1,000. Some of you guys will look into some mistakes. So $172 profit only. Okay, net profits. Okay, and but let's say if any goes, your intrinsic call was 200 here. Let's say any stock price is at 20 bucks. Just for example, again, one more time. The intrinsic value of your call here is 1,000 bucks. Your equity worth here is $2,000. Okay, your total profits here were 2,000 minus your total profits here were 2,000. Hold on. So your equity worth is now $2,000, but then again, you hold a $10 call. This call is worth 1,000 bucks now. So you're gonna buy this back. So your broker will exercise your any equity at this. They will cover this $10 call, and your profits again will also be 172 bucks. Okay. Anything above $10, anything above $10, whether any goes to 1,000 bucks or whatever, you don't get those profits. So your max profits are 172 bucks. If by expiry any trades above 10 bucks. Make sense, guys? Now, when do you lose the most? You don't lose much. You see, if any falls to let's say for example, if any falls to if any stock price goes to 4 bucks, for example, what happens if the stock falls to 4 bucks? Your equity is worth how much? Your equity is worth $400. So your equity is worth 400 bucks. Your total, there are no profits here now, right? Obviously, 828 minus 400. So your equity loss is 428 bucks. Okay, but you gained premium of 200. So there's $200 basically cuts down your loss. All right. So there's $200. So 428, right, minus $200. Your loss is 228 now, because you collected this $200 from premium also. Make sense? You do lose money. I mean, not from option, not from premium sold. You will always make money. You only lose, your profits get limited on covered calls. Your profits get limited. The only thing that you can move, the only way to lose money is when the IV is increased, right, near expiry, and then you don't know what to do, right? As long as your covered call, it stays below your price that you sold, you will only make money on the calls that you sold, as long as it stays below your strike price. Okay, and so you don't really lose money from covered calls, but it limits your profit potential to the upside. That's what happens basically, right? And if your equity goes down, then you get to keep all the premium on the call, but then you only lose on the equity part, which goes down. Okay, and so that, other than that, guys, I think that's the idea of the covered calls basically, right? As long as you're able to know, like here right now, I would not short any, obviously. Maybe if any goes to $10, right? Maybe if it goes to 10, 11 tomorrow with some increased IV, I would look to sell $14, $15 calls same week or the week after, thinking that it does not move that high. And then as soon as I get the 1-2 day flag, these calls will lose premium, right? And if I sell this call at 2, maybe the next day they will be trading at 150, right? And then I can just buy them back at 150, keep that $50 profit against my equity, because equity I'm going to hold anyways. Make sense? And also, so that, So that was the nice little quick session that I wanted to do on covered call, just to give you guys an idea, how to make money. And guys, most of the times when you buy options, or those of you that are new, or if you're not well trained, most of the options that you buy, they actually go worth less than zero. You guys know that, right? I mean, if you go through your track record. So imagine the money that you can make once you have a lot of money on equity. And now this is not something you want to do if you're new into trading. This is not for you. You first want to learn options alone, buying and selling calls puts alone before you move on to this. But this was just an introduction for you guys. Some of you that don't know how many ways there are in the market to make money, right? Go on YouTube, go online, look up option strategies. There are so many. There are strategies which you can make on your own if you're very good with numbers, right? They don't exist in the market, but if you're smart, you can make them on your own and take advantage of them, right? You just have to calculate the numbers and you can make money every which way. You can make the money if the stock goes up, if the stock goes down, if the stock stays sideways, right? But K is confusing right now. It's your first day. I mean, you're new into the market. This is something you learn after months and years of staying in the market, right? But you should be happy that there are so many ways to make money in the stock market. It's not just buying shares and selling shares, right? So a lot of ways to make money. So take this as a positive, I think, right? This is something that you want to learn from. And that's what cover calls are, guys, in very short form, right? Every 100 shares that you own, you can sell one call against those 100 shares. And as long as the stock stays below your sold strike, you make money on the premium sold, right? And that's what it is. And so thank you guys for attending. Just wanted to go over this with you guys. A nice little short session. And those that didn't attend, we'll report it for them. And we'll see you guys back in the chat. And again, put the work in, learn technical fundamentals if you're new. This is a beautiful market and you can pretty much work from anywhere in the world. But again, give yourself time. Don't be in a rush. Don't be greedy and learn how to manage your account. Managing your account is the biggest thing if you want to make money in the stock market. Okay, managing account is the biggest thing in my opinion. So thank you, and we'll see you guys back in the chat tomorrow for pre-market.